interest expenses. This is a popular misconception, and I've seen plenty of folks make mistakes here. So you may think you know what the answers are here, but some of you don't. We have the rental interest on a rental. You have interest deductions. We have purchase money interest. That's always deductible as a rental expense. So if you get a loan on a property that you just bought, you bought it with debt, the interest on that debt's going to be deductible. There are going to be some limitations on it, but generally that interest is deductible. We have equity borrowing on your residence. I've seen a lot of people borrow money on their residence and deduct it, and try to deduct the interest on the borrowing of the residence when you take the money out and you go buy a rental. Guess what? That's deductible as well. And we have some options there. We can deduct at least interest on $100,000 as primary residence interest, and we get to deduct the rest on the rental, or we can make an election to deduct it all on the rental. And it depends upon whether you're limited on your losses as to whether or not we want to do that. So anytime you borrow equity on your residence to put into a rental property, we go through that calculation, we see what's best for you. But home equity indebtedness on equity borrowing on a rental is just, go down to here. Equity borrowing on a rental, what I described with a home equity indebtedness, and you borrow and we elect to trace it to the rental. That's what we do. We elect to trace it to the rental. Well, the equity borrowing in the rental, all you have is tracing only. So if you borrow money on one rental because you built up some equity, and you go buy property, and I borrow on property A to buy property B, I deduct the interest. I trace the interest to property B and deduct the interest on property B. Now, what I have seen is people borrow money on their residence, borrow on their rental, and buy a house with it that they live in, buy property that's not a deductible rental. And we're going to trace that interest to the property that they just bought, which happens to be their house. Okay, and we can all deduct interest on our house, right? Oh, that's true if you bought it, if the debt is on that house. And so I see people borrowing money on their rental properties to buy homes that they live in, and they can't deduct the interest. Okay, so that's an exercise. I've seen folks from this group that have done that, and I've had to give them the bad news. So I just wanted to bring that up. Don't ever do that. Well, you can do it, or if the economics are good, do that anyway, but you're not going to get the deductions. Yes, sir?
But on your last statement, sir, that for your own residence, you could Schedule A that interest expense.
No, you can't. Not if you borrowed that money on your rental. No, you cannot. Because any interest you deduct as residence interest on your Schedule A has to be secured by your residence that you live in. And so that debt is not secured by that property that you live in, no deduction. It's considered, it's as though you'd gone out, borrowed money on your rental, and bought a boat. Same concept. You bought something of personal nature, it's not related to the rental, no deduction. No, that doesn't mean you tell me about it. I was just kidding. I did. No, we never want to say that. Nobody from the IRS here, is there?
It's being recorded.
Oh, yes. Oh, well, I was just joking, of course. Okay, here the gentleman in the back brought this subject up. This is what he was alluding to. We have what we call the passive activity loss rules. This is the bad news. But we have some good news here, but we have some bad news as well. The passive activity rules why some rental losses might not be deductible. Oh boy, I should have drawn a big sad face, because this is especially in the Bay Area where you're all considered rich because you make so much money, because you have to make so much money just to be able to live here. But these rules, by the way, haven't changed since 1986. How many of you aren't making more money than you made in 1986? Yeah, so these numbers get to be a problem. Because what can happen in the passive activity loss rules is your losses might be limited. First of all, we have this $25,000 exception. This $25,000 exception, we call these the mom and pop rules, which means you've got mom and pop that own a few rentals. Congress was interested in allowing them to take their deductions, okay? But mom and pop couldn't have a lot of income, okay? And back in the day, the income limitations were $100,000 to $150,000. So on a 50 cents, you got a $50,000 window here, 25 to get rid of this $25,000. It's 50 cents on the dollar. So when I started 100,000, this is funny. This is for individuals or for a married couple. You can only have you start losing this $25,000 as you get over $100,000. By the time you get to $150,000, that becomes a big goose egg. Okay, so you don't want to be certainly in this market. So many of you are over this number on your other income because you haven't quit your day job and done just rentals. So you're actually having W-2 income, business income, whatever it is. It's pushing you over this, especially if you're married to earners. You have no problem getting over these numbers, and you can't deduct your losses. So back when I was talking about ramping up the depreciation, we're not going to bother doing that for you because you're not going to get a benefit of the deduction today. You'll get a benefit of that deduction, but it may be over time. And this applies to all your rental activities. There is a silver lining that I'll talk about that I'll get to in a minute called the real estate professional rules, but those are some pretty tricky rules. You're allowed to offset. This is a global loss deduction limit, meaning if you have income from property A and a loss from property B, we're not limiting loss on property B to the extent that you have income on property A. So let's say you have a $10,000 income on property A, a $12,000 loss on property B, your limitation will be $2,000. You'll be allowed to offset the entire income of property A, but not take a loss deduction beyond that. Okay, does that make sense? Yes. Okay, let's say you have two properties, property A and property B. Property A generates $10,000 of taxable income. So positive income, $10,000. Property B generates a loss of $12,000, okay? Your loss limitation is going to be $2,000. Your net loss is $2,000. That's what we put through this exception here to see whether or not you can deduct that $2,000. That's what this is all about, is to determine whether or not you can deduct that extra $2,000, your net loss from all your rentals. So you could have $100,000 of losses offsetting $100,000 of income on multiple properties. It wouldn't be a problem. But when you get to the point where you have a net loss for the whole group, then we run them through this limitation. Now you're not going to lose those losses, but you are going to be limited. Again, if you have passive income from other sources, this isn't just real estate. This is any kind of business, any kind of investment, not interest in dividends, not capital gains per se, but capital gains from the sale of rental would be passive income. So oftentimes when we have a rental that we sell and we have taxes, maybe we don't do exchange because we have some carryover losses that we can absorb that gain. Because we have all these losses from these that we couldn't use, they pile up and carry over to future years. And so if I have that $2,000 a year on property B for the next 5 years, I've got a $10,000 loss carryover. But when I sell property A and have a gain, I'll be able to use that $10,000 against the sale of property, the gain on property A. Or if I sell property B, the loss gets used when property B is sold. Any accumulated losses that you've had, doesn't matter whether you have a gain or loss on property B, any loss carryovers you had that are related to property B, and yes, we accountants do have to keep track of all this. They will give you the credit for those losses on property B at that time. All right?